Every morning, millions of people wake up, scroll through their phones, and check their portfolios. They look at Apple stock, Tesla, Amazon, or maybe an ETF that promises steady, low-risk growth. They think they own a small piece of these companies. What they don't realize is that all these shares, all these indexes, are part of something far bigger, a financial empire that quietly holds influence over nearly everything. Its name is BlackRock. Most people have never interacted with BlackRock directly, and yet it affects the prices of their homes, their retirement funds, even their government's economic decisions. It owns shares in the companies that produce their food, make their phones, and stream their entertainment. It's a company that manages more money than the GDP of almost every country on Earth, around $10 trillion. And the strangest part, most people don't even know who runs it. This is the story of how a once obscure firm grew into the most powerful financial institution in history, not by force, not by politics, but by data, algorithms, and quiet control. It begins in 1988 in a small New York office where a man named Larry Fink was trying to rebuild his career. Fink had been a rising star on Wall Street. In the 1980s, he was one of the youngest managing directors at First Boston, a top investment bank. He had everything: influence, respect, a brilliant career ahead, until one mistake cost him everything. In 1986, he made a massive bet on interest rate movements that went wrong, losing the firm about $100 million. In the cutthroat world of Wall Street, that kind of loss was unforgivable. It wasn't just a bad trade, it was a career-ending humiliation. Fink was forced out, branded as reckless. But instead of disappearing, he obsessed over one question: how could a single error in human judgment destroy so much value? The answer, he believed, was simple: emotion. Traders acted on instinct, on ego, on feeling. He wanted something different, a system that could remove emotion from investing entirely. So in 1988, along with a small team of finance and tech experts, he founded a company built on a radical idea: using data and technology to understand and manage financial risk better than anyone else. They called it BlackRock. In its early days, BlackRock wasn't about power, it was about precision. It focused on something most investors ignored: risk management. Fink's vision was to create a system that could measure every possible outcome, every potential risk, and use that knowledge to make smarter investments. To do this, the team began building what would later become one of the most powerful pieces of financial technology ever created, a system called Aladdin. Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network, was designed to do what no human could. It could process mountains of financial data in real time, simulate thousands of market scenarios, and calculate how every tiny movement in interest rates or asset prices could affect a portfolio. It didn't rely on hunches or emotion. It relied on math. In the late 1980s and early 1990s, this was revolutionary. Other firms still trusted the instincts of seasoned traders. BlackRock trusted algorithms. And when financial markets started becoming more complex, with new derivatives, new debt instruments, and global volatility, Fink's approach looked prophetic. Slowly, BlackRock built a reputation as the company that didn't make mistakes. By the mid-1990s, the firm was managing billions in assets for pension funds, governments, and corporations. But it wasn't just managing money, it was watching it. Every portfolio it handled was plugged into Aladdin. Every transaction, every bond, every share was being analyzed in real time by the system. By 1999, BlackRock went public, listing its shares on the New York Stock Exchange. its total assets under management crossed $150 billion. But what really set it apart was the reach of its technology. Aladdin was no longer just used inside BlackRock. Other financial institutions began paying to use it too. Banks, insurance companies, and asset managers, even direct competitors, started relying on BlackRock's system to measure their own risks. Within a few years, Aladdin wasn't just watching BlackRock's portfolios, it was watching trillions of dollars across the entire global financial system. By the early 2000s, BlackRock had transformed from a niche risk management firm into a global asset manager. It didn't make headlines. It didn't advertise. It didn't even have a public face like Goldman Sachs or JP Morgan. It grew quietly, buying small investment firms, expanding its reach, and embedding its software deeper into the global financial machine. The company's rise wasn't built on flashy deals. It was built on trust. Governments trusted BlackRock's models. Central banks trusted its data. Corporations trusted its management. By providing risk management services to almost everyone, BlackRock became something no one fully understood, a company that sat at the center of the financial world, able to see and analyze the flow of global capital like no one else could. In 2008, that trust turned into power. When the financial crisis hit, Wall Street collapsed. Lehman Brothers failed. Markets froze. The global economy was on the brink of collapse. But in the chaos, one company became indispensable: BlackRock. Its Aladdin system had been tracking the risks that other firms ignored. Its models could value complex mortgage securities that no one else understood anymore. And in the middle of the panic, the US government came calling. The Federal Reserve and the US Treasury turned to Larry Fink and his team to help clean up the mess. BlackRock was hired to analyze toxic assets, manage bailouts, and stabilize markets. The firm became the government's private crisis manager. When AIG collapsed, BlackRock helped unwind its massive portfolio of bad bets. When Fannie Mae and Freddie Mac were nationalized, BlackRock managed their assets. When the Fed created programs to buy up distressed securities, guess who was chosen to run them? BlackRock. In a moment when trust in banks had vanished, BlackRock was seen as the adult in the room, the firm that could be trusted to handle trillions without losing control. But in doing so, something extraordinary happened. The US government gave BlackRock access to the deepest parts of the financial system, data about banks, companies, and markets that no private firm had ever seen before, and that information became power. When the crisis ended, BlackRock emerged not just unscathed, but dominant. It had grown to over $3 trillion in assets, and with its government relationships and technological advantage, it began expanding even faster. By the 2010s, BlackRock was no longer just managing money. It was shaping markets. Through its funds and exchange-traded products, it became a top shareholder in nearly every major company on Earth: Apple, Microsoft, Google, Amazon, Coca-Cola, ExxonMobil, Pfizer, and hundreds more. In most of these companies, BlackRock's ownership ranged from 4 to 8%. That might sound small, but when combined with other giant asset managers like Vanguard and State Street, who often vote the same way, it meant that a handful of firms effectively controlled corporate America. The company didn't need to own majority stakes to control outcomes. Its influence came through scale, data, and its voting power at shareholder meetings. BlackRock could quietly steer corporate policy on everything from climate change to executive pay to political donations, all without the public ever noticing. And yet, for all its size, it remained invisible. its CEO, Larry Fink, was no celebrity. He avoided interviews, he didn't appear on magazine covers, but every year, his letters to CEOs around the world carried more weight than presidential speeches. He talked about long-term value, corporate responsibility, and sustainability. And companies listened, because ignoring BlackRock meant risking the support of their largest shareholder. A company that began by managing risk was now shaping the direction of capitalism itself. And yet, few outside the financial world even knew its name. By 2015, BlackRock managed nearly $7 trillion, more than any hedge fund, more than any bank, more than the GDP of Japan. Its technology monitored the portfolios of thousands of institutions, controlling a web of financial influence that stretched into every corner of the global economy. In just 3 decades, a small team of risk analysts had built an empire without borders, a company that didn't need armies or propaganda to control the world. It only needed ownership. But power rarely stays invisible forever, because while BlackRock had mastered the art of quiet influence, its growing reach was starting to draw attention. Politicians, economists, and even activists began asking the same question: how much power is too much? And as the world entered a new era of political instability and economic transformation, that question was about to take center stage. The invisible empire was no longer invisible, and soon the world would discover what it really means when one company owns a piece of everything. If you were to look through the list of shareholders for almost any major company on Earth, Apple, Amazon, ExxonMobil, JP Morgan, Google, Coca-Cola, you'd find the same name again and again: BlackRock. No ads, no flashy headquarters, just a quiet line in a shareholder register that represents billions of dollars of ownership. What started as a risk management firm in 1988 has become a silent partner in nearly every business that defines modern life. Most people don't realize that when they buy a mutual fund or an exchange-traded fund, an ETF, they're often giving their money to BlackRock to manage. It's not investing directly in Apple or Tesla, it's investing through BlackRock. Over time, those small investments add up to something enormous. This is how the empire grew invisible. In the early 2000s, a revolution was underway in finance: passive investing. Instead of trying to beat the market, investors began to accept it. They poured money into index funds, baskets of stocks designed to mirror entire markets like the S&P 500. The logic was simple. Most fund managers fail to outperform the market, so why not just own the whole thing? It was a shift that changed everything. BlackRock saw it coming early. In 2009, it bought a company called Barclays Global Investors, and with it, the iShares brand, the largest group of exchange-traded funds in the world. Overnight, BlackRock became the undisputed leader of the passive investing revolution. The idea was genius in its simplicity. Instead of picking winners and losers, BlackRock would own everything. If Apple rose and Exxon fell, it didn't matter. BlackRock held both. As long as markets grew, so would its power. Within a decade, trillions of dollars flowed into its funds. Every time someone put money into an S&P 500 ETF, a piece of that money went to buy small stakes in hundreds of companies. That meant BlackRock and firms like Vanguard and State Street were buying slices of virtually every major corporation in America and much of the developed world. By 2020, those 3 firms together controlled around 20% of the average S&P 500 company. They didn't own everything outright, but they owned enough to influence everything. The brilliance of passive investing was also its trap. Because the system required no decision-making about which companies to invest in, it made BlackRock appear neutral. a simple middleman. But neutrality in finance doesn't exist. Even small choices, how funds are structured, how votes are cast at shareholder meetings, how companies are categorized, carry enormous power. BlackRock's influence became clearest in corporate governance. Every year, companies hold votes on issues from executive pay to climate strategy. Individual investors rarely bother to vote, so BlackRock votes on their behalf. Through that mechanism, the company casts millions of votes every year, quietly shaping corporate behavior across the globe. It can pressure oil giants to invest in renewable energy or convince tech companies to change privacy policies. Sometimes it acts as a force for reform. Other times it protects the status quo. But the key point is that a handful of executives in New York can influence decisions that affect the entire global economy. BlackRock's reach doesn't end with corporations. Its relationships with governments have blurred the line between public policy and private power. After the 2008 financial crisis, the US government discovered that BlackRock's expertise and its Aladdin system could be used not just for managing portfolios, but for managing national emergencies. When the Federal Reserve needed to buy up toxic mortgage securities to stabilize the economy, BlackRock was hired to run the program. When the European Central Bank launched its massive bond buying campaign, BlackRock advised it on which bonds to buy. Each crisis deepened the connection between the world's most powerful states and this one private firm. In 2019, when the Federal Reserve quietly tested how to respond to another financial shock, it again turned to BlackRock. A year later, when COVID-19 shut down global markets, the Fed used a plan almost identical to the one designed by BlackRock years before, and again hired the firm to execute it. In effect, BlackRock became the government's crisis manager. It wasn't elected, it wasn't accountable, but it had the tools and the data no one else had. This revolving door between regulators and the company strengthened its position even further. Former central bank officials joined BlackRock. Former BlackRock executives went into government. The firm's senior advisors included former heads of the Federal Reserve Bank of New York, European regulators, and Treasury officials. It wasn't conspiracy, it was convenience. When governments needed help, they turned to the people who understood the system best. But those people also happened to be the same ones running it. This new form of power was almost invisible. There were no headlines announcing BlackRock's rise, no public speeches about its influence. Instead, its authority grew quietly in spreadsheets, in algorithms, in the silent hum of data centers processing the world's wealth. Aladdin, the system that started as a risk management tool, had become a nervous system for global finance. Every day, it analyzed tens of thousands of portfolios, monitoring trillions in assets. A glitch in Aladdin wouldn't just affect one company, it could ripple through pension funds, governments, and central banks simultaneously. Few outside the industry even knew it existed, yet more than 200 institutions relied on it daily. That included the Bank of England, the European Central Bank, and some of the world's largest insurers and sovereign wealth funds. Through Aladdin, BlackRock didn't just manage money, it watched over it. By the mid-2000s, critics began calling BlackRock a shadow bank, a kind of informal central bank with no public oversight. The firm could influence interest rate policy, bond markets, and stock valuations without ever appearing in the news. And unlike traditional banks, it faced none of the same regulations. It didn't take deposits, so it wasn't classified as a bank. It didn't issue loans, so it avoided capital reserve requirements. It existed in a legal gray zone, too integrated to ignore, too different to regulate. When journalists tried to quantify its influence, the numbers were staggering. BlackRock was the largest shareholder in more than half of the publicly traded companies in the United States. Globally, it held stakes in around 17,000 firms. Its funds owned vast portions of critical infrastructure, airports, energy companies, utilities, housing developments. Even defense contractors and social media giants had BlackRock in their ownership mix. Its total assets under management exceeded $9 trillion. If BlackRock were a country, its economy would rank third in the world, behind only the United States and China. But size alone doesn't explain its power. The deeper influence comes from the way it links everything together. When one company fails, BlackRock's portfolios connect that failure to thousands of others. It's a web so dense that global markets move in sync, reacting not to individual companies, but to the flows of capital within BlackRock's funds. Some economists call this the BlackRock effect, a phenomenon where stock prices move less because of business fundamentals and more because of how index funds allocate money. When a company enters an index, its stock price tends to rise automatically. When it leaves, it falls. BlackRock's massive funds amplify those movements, subtly steering market behavior without any direct intervention. The firm insists it acts only as a fiduciary, following the will of investors. But those investors, pension funds, retirees, small savers, don't decide how their shares are voted, how risk is calculated, or how assets are distributed. BlackRock does. By 2017, some academics were warning that this quiet concentration of ownership was eroding competition itself. If the same three asset managers own shares in all competing airlines or all major banks, are those companies truly competing? When the same shareholders profit no matter which firm wins, the incentive to challenge each other disappears. Prices rise, innovation slows, and power consolidates further. BlackRock dismisses those claims, arguing that it simply reflects the will of millions of individual investors pooling their money together. But behind the scenes, regulators in Washington and Brussels were beginning to ask uncomfortable questions. How do you regulate a company that sits at the center of everything? The irony is that BlackRock's success was built on the very thing it promised to prevent: risk. By spreading ownership so widely, it had made markets more stable on the surface, but also more fragile underneath. If a shock ever forced investors to pull their money from index funds at the same time, it could trigger a chain reaction unlike anything before. The financial system was now so interconnected that BlackRock's size made it both too big to fail and too big to regulate. Larry Fink rarely spoke about power. In interviews, he preferred to talk about responsibility. He described BlackRock as a custodian, a steward of other people's money. Each year, his letters to CEOs emphasized long-term thinking and sustainability. He spoke about climate change, diversity, and social governance. He urged corporations to act ethically, not just profitably. To many, it sounded like the words of a visionary. To others, it was the voice of a king addressing his vassals. When the world's largest shareholder tells you to change your business practices, you listen. By the end of the decade, BlackRock wasn't just part of the financial system, it was the system. Its technology underpinned the risk models of entire governments. Its funds shaped the structure of global stock markets. Its executives advised presidents and prime ministers. And yet, most people still couldn't explain what it actually did. The invisible empire had achieved something that no political empire ever could. It ruled without being seen, and it expanded without being named. But every empire, no matter how quiet, eventually reaches a point where it must face scrutiny. In the next few years, BlackRock's growing influence would collide with a changing world, climate politics, populism, and the backlash against corporate power. And as the firm began to use its power to reshape capitalism itself, the question shifted from how big can BlackRock get, to who, if anyone, can stop it. By the late 2000s, the world had changed, and so had BlackRock. The 2008 financial crisis was fading into memory, but the system it created was still fragile. Political populism was rising, inequality had widened, and trust in institutions, from governments to corporations, was collapsing. People were angry, searching for someone to blame. And at the top of the economic pyramid sat a company most had never even heard of. Larry Fink understood something crucial. In a world growing skeptical of Wall Street, survival would depend not on power, but on perception. So he began to reshape BlackRock's image from a quiet behemoth of finance into a moral compass for global capitalism. Each January, Fink published his now famous letter to CEOs. In it, he spoke not as an investor, but as a kind of philosopher king of the financial world. He told corporate leaders that the era of shareholder-only capitalism was over, that companies must serve a social purpose, fight climate change, and treat employees ethically. He called this vision stakeholder capitalism. Coming from anyone else, those letters might have sounded like PR. But when the world's largest investor speaks, people listen. Fink's words could move boardrooms, shift stock prices, and set global agendas. Overnight, the idea of ESG, environmental, social, and governance investing, became the new moral standard. In 2019, BlackRock announced it would begin factoring climate risk into all its investment decisions. It started pushing companies to disclose their carbon footprints and support renewable energy. For many, this looked like progress, capitalism finally evolving to confront the planet's biggest challenge. But critics saw something else: the consolidation of moral authority in a company that already held too much economic power. Behind the ESG push, BlackRock's structure remained the same. It still owned large stakes in oil companies, arms manufacturers, and tobacco producers. It still managed state pension funds for conservative governments and invested billions in fossil fuel infrastructure. Its green funds were often built on the same index models as its traditional ones, just branded differently. What Fink had created wasn't a revolution, it was a rebranding of capitalism itself. To its supporters, BlackRock was leading the world toward a sustainable future. To its detractors, it was controlling the narrative, setting global policy without democratic consent. In their view, ESG gave BlackRock the power to decide what counted as ethical, what counted as sustainable, and which companies were worthy of survival. By 2020, this quiet authority began to provoke backlash. Conservative politicians in the US accused BlackRock of using its financial clout to push a left-wing agenda. Environmental activists accused it of hypocrisy. BlackRock found itself attacked from both sides, too progressive for some, too complicit for others. Then, the pandemic hit. In March 2020, global markets collapsed as COVID-19 spread. Governments scrambled to stabilize economies. Once again, the Federal Reserve turned to BlackRock, asking it to run emergency programs to buy up corporate debt. The same company that managed trillions in private assets was now managing public rescue funds. For critics, this was the final confirmation. BlackRock had become a shadow government, a private institution with public power. Its fingerprints were on every recovery effort, every bond-buying program, every major bailout. And while small businesses were shuttering, the assets under BlackRock's control surged past $10 trillion. When the dust settled, Larry Fink emerged as perhaps the single most influential financial figure alive. Presidents and prime ministers consulted him. Central banks relied on his software. Corporations adjusted their strategies to please him. Yet, even as the empire grew stronger, cracks were forming beneath the surface. BlackRock's dominance in index funds was creating a paradox. The firm's promise was simplicity, a passive investment that mirrored the market. But the larger it grew, the less passive it could remain. Every vote it cast, every policy it endorsed, now reshaped the market itself. The mirror had become the sculptor. In 2022, regulators began warning that index investing might be concentrating too much power in too few hands. Some economists argued that BlackRock, Vanguard, and State Street together effectively functioned as a single financial bloc, the new oligopoly of global finance. The political mood was shifting too. Populist movements on both the left and right began to target BlackRock as a symbol of elite control. In France and Germany, protesters accused it of influencing pension reforms. In the US, Republican-led states began withdrawing billions from its funds, accusing it of promoting woke capitalism. The quiet empire was finally being seen, and the world didn't like what it saw. But inside BlackRock, Fink remained calm. He had weathered crises before, and he knew the truth. The system itself couldn't function without him. Governments could criticize him, but when the next market crash came, they would still call. The world's financial plumbing was too entangled with Aladdin, too reliant on BlackRock's algorithms to separate from it now. Even if everyone turned against the company, it was simply too integrated to fail. By 2023, however, the narrative had turned darker. Investigations into BlackRock's real estate investments revealed that its subsidiaries were buying thousands of single-family homes across America. The idea of a faceless financial giant buying entire neighborhoods sparked outrage. Social media exploded with claims that BlackRock was buying up the country. The truth was more nuanced. BlackRock didn't own most of those houses directly. It invested in funds that did. But the optics were damning. To many, it looked like the ultimate symbol of corporate overreach, a trillion-dollar firm turning homes into assets and citizens into tenants. For the first time, Larry Fink himself became a villain in the public eye. Protesters appeared outside his Manhattan office holding signs that read, "BlackRock owns you." In interviews, Fink seemed frustrated. He argued that the anger wasn't about BlackRock at all. It was about capitalism itself. "People are confused and scared," he said. "We're just the face they see." But that was the point. For decades, BlackRock had hidden in plain sight, operating behind layers of abstraction. Funds, indexes, algorithms. Now it had a face and a name. The invisible empire was visible at last. As the decade unfolded, the company faced new challenges. Rising interest rates and inflation slowed its growth. The ESG movement fractured under political pressure. Investors questioned whether sustainable investing had ever been more than a marketing strategy. And governments around the world began drafting new regulations to limit the power of global asset managers. But even as scrutiny grew, BlackRock's dominance endured. Its technology still powered the risk systems of banks and central banks. Its funds still shaped the structure of every major index. Its influence remained woven into the code of global finance itself. Larry Fink often said that BlackRock's mission was to build a better financial future for everyone. But the question that lingers is whether any institution, no matter how well-intentioned, should hold that much power over the world's wealth, over the choices of governments, over the fate of capitalism itself. Because in the end, BlackRock didn't conquer the world through deception or aggression. It conquered it through efficiency, through the quiet logic of data and trust, through the idea that risk could be managed and control could be invisible. It became what every empire dreams of being, indispensable. And yet, history tells us that every empire, no matter how subtle or benevolent, eventually faces its reckoning. The difference with BlackRock is that its empire isn't built on land or armies. It's built on ownership. Its territory is every company, every home, every pension, every market. Its subjects are not citizens, but investors. Maybe that's why it's so difficult to see where its influence ends, because in a way, we're all part of it. Anyone with a retirement fund, a savings plan, or an index investment is feeding the machine. BlackRock's empire is not imposed on the world. The world volunteered for it. And that is what makes it so powerful. The story of BlackRock isn't about greed or corruption. It's about evolution. How capitalism, in its pursuit of stability, created something beyond the reach of politics or ideology. A system so vast, so efficient, so intertwined with the global economy that it no longer needs permission to rule. It rules by default. One day, perhaps, that system will face a collapse or a rebellion or a transformation that no algorithm can predict. But until that day, the world will continue spinning under the quiet watch of a network of servers and spreadsheets, a digital empire without borders or banners, ruled by no nation, loyal to no ideology. An empire whose power lies not in what it owns, but in what it manages. And if you ever want to see it, you don't need to look at the stock market or Wall Street. You just have to look in the mirror, because in one way or another, you're already part of it. The invisible empire didn't conquer the world. We handed it over willingly